Today's tax meeting is an overview of BEPS Pillar 2. The aim of Pillar 2 is to ensure that all internationally operating businesses pay a minimum level of tax. The minimum level of tax that has been agreed is 15%. It only applies to large multinational groups, and we'll come on to the meaning of that in a minute. There are two main elements to the Pillar 2 rules. Firstly, there are the GloBE rules, and GloBE stands for Global Anti-Base Erosion. These rules have two charging mechanisms. The primary charging mechanism is an income inclusion rule, or IIR, and this imposes top-up tax on parent entities in respect of low-taxed income of one of their subsidiaries. Then there is the secondary charging mechanism, which kicks in where it has not been possible to collect all of the top-up tax under the primary mechanism, and that will impose the top-up tax on other entities within the group. Finally, there is a switchover rule, and this removes treaty obstacles to the application of the IIR in relation to certain branch structures. And then the other part of the Pillar 2 rules is a subject to tax rule, and this will allow source jurisdictions to impose limited source taxation on certain related party payments where they are subject to tax below a minimum rate. And this will really be limited to where the source country is a developing country. We're now going to focus on the GloBE rules, and I like to think of these rules as a jigsaw with 5 steps. The first step is to work out whether a group is in scope. You also need to consider at this stage whether any of the entities within the group are excluded entities. Next step is to allocate income and taxes to entities that are members of an in-scope group. Those entities are called constituent entities. The third step is to calculate the effective tax rate for each jurisdiction. The fourth step is to allocate top-up tax to constituent entities within that jurisdiction. And then finally, you need to look at the charging mechanisms to collect the top-up tax that you have calculated is due. Before we dive into the detail of these rules, I thought it would be useful to set out a timeline showing what has happened so far and what is still to happen. Although these measures had been negotiated for a number of years, the first real indication that we had that something was actually going to happen was when a statement was published by the OECD last July. That was followed up in October 2021 with a further OECD statement setting out what had been agreed and the timeline for the implementation of the measures. We did not see any detail until December 2021 when the OECD model rules were published. That was followed swiftly by an EU draft directive, and in early January 2022, the UK published its consultation on the implementation of Pillar 2 into UK law. It wasn't until late winter, early spring when the OECD published its long-awaited commentary on the model rules. As at the date that this session was recorded, the UK still seems to be targeting an effective date for the bulk of the rules to come into force of April 2023, with the remainder of the rules targeted to come into effect in April 2024. So the intention is that UK draft legislation would be published on L Day this summer, so probably sometime in July. However, this will make the UK one of the first movers, if not the first mover in this area, and it may be that the UK listens to representations from business and delays the proposed effective date. One of the real concerns around an April 2023 effective date is that we are still missing quite a bit of detail around how these rules will be implemented because the OECD has not yet published its implementation framework. That is expected in late 2022, possibly as late as December. The EU, although they published a draft directive in December 2021, have not yet managed to reach agreement on that draft directive in ECOFIN meetings. The effective date has been pushed back to possibly 31st of December 2023 for the first tranche of the rules, possibly 1st of January 2024, but as at the date that this session was recorded, no final agreement had been reached amongst EU member states. To be in scope of Pillar 2, the group needs to be a large international group. So it needs to have revenue of 750 million euros. That's the same threshold as the country by country reporting, and it needs to be operating in 2 or more jurisdictions. This could be through 2 entities, but it could also be a main entity with a permanent establishment in another jurisdiction, and that's to stop groups from using a branch structure in order to avoid the rules biting on them. Members of a group are called constituent entities, and we'll be using that term quite a lot as we go through this. The next thing to consider is whether there are any excluded entities, and the excluded entities are government entities, international organisations, non-profit organisations, pension funds, investment funds, real estate investment vehicles, and certain holding entities. If an entity is an excluded entity, then it is not a constituent entity. And what this means is that no effective tax rate calculation would be required for that entity. And it also means that that sort of entity would not be subject to the income inclusion rule or undertaxed payment rule charging mechanisms. And that's because those charges only apply to constituent entities. So now that we know who's in the group and who's within the scope of these rules, the next thing to do is to allocate income and taxes to constituent entities. So firstly, you need to calculate the constituent entity's GloBE income. And the starting point will be the income allocated to the entity using the accounts applying the ultimate parent entity, that's the entity at the top of the group, applying the financial standard that has been used to draw up the ultimate parent entity's financial statements. So you take that income and then you need to apply certain adjustments to it. For example, you would need to remove any dividends and gains from the disposal of shareholdings in which the entity holds a 10% or greater interest, and you would also need to reverse certain deductions such as bribes and large fines. There are special rules for allocating income to permanent establishments and to tax transparent entities. We will cover those in a later session. You then need to calculate the constituent entity's covered taxes. And covered taxes are taxes on income and profits only. So the starting point will be the tax expense that the entity has shown in the financial accounts. As I said, we're looking for taxes on income and profits only, so you would strip out things like sales taxes, VAT, payroll taxes or social security contributions like NICs, and you would also take out transactional taxes such as stamp duty. Again, a series of adjustments will be required. For example, you would take out any tax on income where the income is not within the scope of the GloBE rules. So as I said, dividends from 10% or larger shareholdings are not regarded as GloBE income. So in the event that any such dividends have been charged to tax, you would strip out the tax on those dividends. The next step is to calculate the effective tax rate for the jurisdiction. This is calculated on a jurisdictional basis. So what you do is add together the GloBE income or loss for each constituent entity in the jurisdiction that you calculated in step 2. Then you add up the covered taxes figure that you calculated in step 2 for each constituent entity in the jurisdiction. You then divide the aggregate covered taxes for the jurisdiction by the net GloBE income or loss for the jurisdiction to get the effective tax rate. So the effective tax rate is the aggregate adjusted covered taxes divided by net GloBE income. The minimum tax rate is 15%. If the effective tax rate for the jurisdiction is below this, then top-up tax is likely to be chargeable. If the effective tax rate is 15% or more, then top-up tax won't be chargeable unless there is an adjustment that needs to be made relating to an earlier year. The next thing to do is to calculate the top-up tax that's actually payable. And the first step to take here is to calculate the top-up tax percentage. The top-up tax percentage is the 15% minimum tax rate less the effective tax rate that you just calculated. So if the effective tax rate is 12%, then 15% less 12% would give you a top-up tax percentage of 3%. That top-up tax percentage is then multiplied by the GloBE income, but you need to deduct a substance-based exclusion from the GloBE income unless the group has opted out of that exclusion. The substance-based exclusion exempts a portion of the income from top-up tax. It's based on the employees and tangible assets in a jurisdiction, and we'll look at the detail of that carve-out in a future session. The next adjustment that may need to be made is to deduct any domestic minimum top-up tax that has been paid. Domestic top-up tax is an extra tax that is levied under domestic tax rules to basically top up the effective tax rate on entities in that jurisdiction to 15%. If a jurisdiction has introduced this, and the UK is considering this, then that would be deducted at this stage of the calculation, so that there is no top-up tax payable. Finally, you might need to factor in an adjustment that has been made in relation to an earlier year. You then need to apportion the top-up tax that you have just calculated between the constituent entities in the jurisdiction. And it is apportioned pro rata to the GloBE income of entities with GloBE income in the jurisdiction. So a loss-making constituent entity in the jurisdiction will not be apportioned any top-up tax. The final piece of the jigsaw is to actually charge the top-up tax. And the primary mechanism is the income inclusion rule, or the IIR. Under this rule, the parent entity pays top-up tax of a low-tax constituent entity in proportion to the ownership interest that it has in the low-tax constituent entity. A parent entity is a constituent entity that owns an interest in another constituent entity. And the rules are top-down. So broadly, what you do is start with the ultimate parent entity, that's the entity at the top of the group, and work down the corporate chain until you find a parent entity in a jurisdiction that has implemented an income inclusion rule. There are special rules that we will tackle in a later session, which deal with the situation where there are minority interests in the low-tax constituent entity. Top-up tax is charged in proportion to the ownership interest. So if the ultimate parent entity only holds an indirect 80% interest in the LTCE and there is no lower down parent entity in the group with a larger interest, then only 80% of top-up tax of the LTCE will be charged to the parent entity under the income inclusion rule. The secondary charging mechanism is the undertaxed payments rule, and this only applies where top-up tax was not picked up through the income inclusion rule. Under the model rules, this would be the case if there was no parent entity in an income inclusion rule jurisdiction. So in the previous example, if either the UPE or an intermediate parent entity, IPE, are in an IIR jurisdiction and hold an 80% interest, you wouldn't look to pick up the remaining 20% through the undertaxed payment rule. Now, rather confusingly, the payment doesn't need to be undertaxed, doesn't even need to be a payment in question. So how do you actually go about charging? Well, the tax that needs to be charged under the undertaxed payments rule is allocated to constituent entities within the group that have tangible assets or employees located in their jurisdiction. So there doesn't actually need to be a link between the low tax constituent entity and the entity that you are looking to charge with tax under the undertaxed payments rule. All that entity needs to have is tangible assets and or employees. Note that you might actually be charging low tax jurisdictions, entities in low tax jurisdictions with top-up tax under this rule, provided that the jurisdiction has implemented the UTPR rule and it has either employees or tangible assets. And it will be up to the jurisdiction to determine how to allocate top-up tax that has been charged under the UTPR in between constituent entities within that jurisdiction. And that's all we were going to cover today. So this gives you a broad overview of the GloBE rules, and in coming weeks we will be looking at the detail of each of these different bits of the rules.